Hi, my name is Mark Prather. I'm broker of Mark One Real Estate and Mortgage. Thank you for joining us in our Roadmap to Wealth program. The American dream for most of us consists of the three following things. First, building our lives, which consists of our career and our families, buying a home, and ultimately retiring comfortably. But the rules of retirement have changed. Our world has changed from the days where you could rely on company pension plans. For the most part, most companies have either vastly reduced their pension plans or eliminated them. With the exception of government programs or government employees, pretty much everyone else, those pension plans are no longer sufficient. Relying on Social Security is not an answer. As I think most of us are aware, Social Security as a supplement is helpful, but is not nearly enough. All right, let's look at some scary statistics about the average American when it comes to their retirement. 46% of American workers have less than $10,000 in their savings. 29% have less than $1,000, and a full 25% have no money saved. When it comes to your retirement, there are two questions that you must absolutely be able to answer. The first one is, how much monthly income will you need when you reach retirement? Now, depending on what your age is going to really dictate that. In other words, someone that is, let's say, 30, 35 years old, they're looking at retirement in another 30, 35 years, so the amount of income they're going to need at retirement is going to be significantly more than someone that's going to be retiring probably, let's say, in 10 years. So that's the first question, is how much monthly income do you need to retire? The second is, how much money do I need to accumulate in investments to generate the income I need? Most people have no idea about, they just don't realize that to accumulate the money that you need for the retirement income is far greater than most people believe. With our Roadmap to Wealth program, we're going to not only show you a very achievable plan to help you accumulate the assets or investments that you need to generate the monthly income you need, but we're also going to show you the process of how to do this. Limited financial advice can cost you thousands. Now, in most cases, when people are planning or thinking about their retirement, what they'll do is they'll either talk to a financial planner or an investment banker. They'll go to large firms like Merrill Lynch and that. While these companies do a terrific job of laying out a retirement plan, the only investments that they will share with you as far as strategies that you can invest in are financial products that generally they sell, which include stocks, bonds, mutual funds, insurance products such as annuities. What they do not do, and what they're totally unaware of, is just how superior the rate of return is on real estate compared to these other investments. Our Mark One Wealth Academy Return on Investment Forecaster can assist you in doing the projections that will illustrate just how you can reach your financial goals. In accumulating wealth, there are three keys. These are the three keys that the most powerful tools used by billionaires. They're the same keys used by Donald Trump in accumulating his real estate empire. They're the power of compounding, the power of leverage, and the power of staying the course. The power of compounding, most people are familiar with the power of compounding, which is, compounding is simply taking whatever your principal investment was that you began with, and the interest that is added to that each year it compounds, so you're building interest on top of the interest that is added, and that's how your investment will grow through the years. But what most people are not aware of is how powerful compounding is over time. Here's a chart that illustrates that. We're showing one person here that started saving at 24 years old, saving $12,000 a year or $1,000 a month. And then at age 33, they stop saving. From age 34 through 65, they no longer save at all. But if you'll notice, you'll see how the compounding grows through the years and how they end up with over $1 million. It's $1,028,000. Now, what I want you to pay particular attention to is if you look at those last 5 to 10 years, you'll see the jumps are very substantial each year in increments of $30 and $40 and $50,000 per year. Now the second person doesn't save anything from 24 to 33 and doesn't start saving until 34. And then from 34 to age 65, they save that same $12,000. So you can see they've saved more than 3 times as long as the first person. And yet at the end, their total compounded return is very similar to the first person at the $1,030,000. Now next is the power of leverage. Nearly every investment has the compounding effect, but very few have the power of leverage. Let me explain how leverage works. Leverage is when you obtain a loan to provide the funds to invest. To do this with stocks is extremely risky. The reason is if the stock market takes an extreme drop or the company itself fails, the bank that has made the loan will call the loan. And when this happens, your investment may completely dissolve. This is not the case with a mortgage on real estate. The tremendous advantage that leverage creates for real estate investment is that your rate of return is not based on your investment or the down payment. Instead, it's based on the value of the property. This is called leverage, and it's what protects most real estate investments. Here's one comparison of an investment in real estate versus investing in the stock market. Now, this historical chart dates back to January of 1990. It's showing you in Los Angeles County the median price for a home was $200,000. And if you'll see in the early 90s, if you recall, there was a recession at that time. The mid-90s, the economy started to stabilize and started moving forward. And you see how property values increased through the late 90s and continued to increase all the way until 2007. And then in 2008, we had the financial meltdown. The property values dropped anywhere from 40 to 50%. And then in 2010, I would say we bottomed and rates, the property value started to increase again. Now this chart ends in January of 2014. Here we are in 2015, and the property values have continued to rise. Now let's compare this to the Dow. If you look at the Dow Jones, in January of 1990, it was at 2,500 was where the Dow stood. You'll notice that it very much mirrored the real estate market because of the recession and the overall economy. Then the stock market started to improve, the Dow improved. In 2001, 2002 there, we had a decline, which was the end of the dot-com bubble. Then the stock market started improving again. Then we hit the financial crisis and it dropped. And since 2008, it's been steadily climbing, and we're upwards now of about, the Dow's around 18,000. Now, if you compare this Dow report to the real estate market, they look very, very similar. And the reason is both are largely driven by the economy. Now, here's a side-by-side analysis of the Dow versus real estate. Investing $12,615 in the Dow or $12,615 into real estate. This starts in 1990 through 2014. The Dow investment would have appreciated in value to $81,596. If you deduct your initial investment, your total return is $68,980. So let's call it $69,000, with an annual return on investment of 21.8%. If you took that same $12,615, bought a median priced home in LA County for $200,000, that home is now worth $486,000. If you deduct your initial investment plus the purchase price of the property, your total return in dollars is $273,000. So you can see the gain in dollars is nearly 4 times as much. You look at the annual return on investment, 137% compared to the 21.8%. The reason is what we talked about earlier, which is leverage. The return on real estate, the reason it is so much superior to the Dow is, look at the second line there where it says investment value. When you invest $12,000 into the Dow, 12,000 is 12,000. But when you buy a piece of real estate, particularly the beautiful part about California real estate is the constant demand because of people constantly wanting to move to California. The investment value, even though there's $12,000 invested, the investment value is $200,000. So the rate of return is attached to that investment value. As property values appreciate, that's why your rate of return on your cash investment is so much greater than the Dow or other types of investments in the stock market and similar because of this leverage factor. So when it comes to rate of return, why is real estate the best choice? Well, it's simply because the rate of return you're going to receive on real estate is far superior to the stock market because of the leverage factor. Accumulating wealth through real estate is the fastest and safest strategy that you can use. Now, two big mistakes that could ruin your ruin your retirement. One is careless spending. Many consumers are very relaxed when it comes to monitoring their spending habits, and they spend excessively when it comes to items like cars and clothing and things of that nature. So controlling spending habits is very important. The second is cashing in early. The biggest mistake I've seen that the typical consumer has made is that they don't stay the course of their investment plan. What most consumers will do is they'll start off when they buy their first home, then 5 to 7 years goes by and they want to upsize. When they want to upsize, they sell that first house, they buy a much larger property, but they also get a much larger mortgage. When they do this, their cost of living goes up, their payments are higher on their mortgage, property taxes are higher, and maintaining the property is much more expensive. With this, two unfortunate things happen. First is the compounding that began stops, and now they have to start all over again. And second is the consumer is now carrying much more debt than they had before. By having this higher debt amount, it limits their ability to invest in anything, whether it's additional real estate or stocks and other types of investment. So the process of upsizing to the biggest house possible is not a good strategy. Now here's a chart about sharing the historical price appreciation in California. This is from the California Association of Realtors. From 1968 through 2012. You can see in 1968 the median price for a home in the state of California was $23,210. And through the years the prices have just steadily gone up. Now there are always runs where you'll have significant increases and then some will be more gradual. But the process from 1968 forward, and we could go back farther than that, the cost of real estate is generally it's one direction. It gradually just keeps going up. This is the historical average. If you look at the last 44 years, the average appreciation rate on a property in California is 6.9%. On a nationwide basis, it's 5%. Now, this analysis, you can see that if a borrower, or a buyer, I should say, was to purchase a property for $450,000, FHA, here's their down payment of $15,750, their closing costs, so their total investment's about $25,000. They hold this property for 15 years using the 6.9 average appreciation rate. The estimated value at the end of the 15 years is $1,224,000, and their new equity position is $934,000. If we go down to the bottom, you can see after tax write-offs, when you include that, their total return with tax savings is over 4,000% over the 15 years, and you divide that out over the 15 years, you have an annual rate of return of 272%, which by most standards people would agree is pretty incredible. And again, the reason is leverage. So how do you become a savvy real estate investor? Well, that's where we will come in. We would like to be your real estate investment consultant. Our role is to help our clients develop and execute a long-term financial investment plan to help you to achieve your financial independence. We help our clients successfully manage their real estate portfolio through balance in their investing, through safety, in making wise investments, in rate of return, and in tax deductions. As you probably are aware, real estate has very favorable tax status. I appreciate your time in viewing our PowerPoint in our investment strategy with the Wealth Academy. I hope you choose to meet with one of our agents and discuss how this program can benefit you. Thank you.